My name is Mark Nelson, Director of Commodities with Kansas Farm Bureau. And as we usually do, what I want to do today is just kind of look at marketing plans. Obviously, these are the things that we feel like people need to have a marketing plan to follow. Now, again, I'm going to run through what some ideas we have. Definitely, these are not your recommendations for you, but these are some thoughts that we have, that I have, and some decisions we need to be thinking about. So, when we think about active marketing plans, you got 2023, so last year's crops that we still may be hanging on to. And I'll tell you, I just throw this up. Basically, that's a little chart of my tracking of what storage of wheat, corn would have been doing. And we're far and away not making any money storing corn. Beans, wheat, the same thing. So basically, I'd say, hey, on 2023, we should be thinking about wrapping things up. I know in some places we're seeing bases maybe on the corn side strengthen, and some folks are thinking, maybe I could hang on, and maybe there's some potential. But by and large, I think we ought to be wrapping those 2023 plans. First thing I'll do from here then is move on and kind of give you a quick review of post-harvest plans for feed grains, soybeans, and wheat. So our 2024 crops that we haven't even, the wheat's in the ground, but the beans and the corn are getting planted, and we still have a long ways to go there. But the other thing I think we need to be thinking about, and I'll talk a little bit about this too, is this where I'll end, is thinking about 2024 post-harvest wheat, right? It started to shoot heads in some places, probably sooner than we'd like it to be, but harvest is going to be here in 2 months. What are we going to do with that crop? And it's time to start thinking about what plan I want to develop there. So moving on then, basically, I'm just going to give you two general thoughts. Number one, these are not recommendations as much as ideas that we feel like you should be, as farmers, as lenders, as folks that are out here in the industry, you ought to be considering. We definitely want to have a plan. I also want to throw this one here out as a general thought. Overall, grain and oilseed prices are down from a year ago, which is probably the understatement of the year. And interest rates are up, and I think we know both those things. And we know that they're also narrowing profit margins. But this last week or two, we've had some, I don't want to call it bad news, but it's showing that inflation is getting to be very sticky. And I think there's some real concerns that we may not see that narrow or decreasing in interest that I had hoped for by the end of this year. Because I was hoping that 2024 would be a one-off, right? Higher interest rates. But when you think about, let's say we have an average operating note of $1.5 million. And I was at a conference the other day, and someone in the banking industry said in Western Kansas, the average operating note is more like $2 million. If we're seeing a year-to-year increase of 5%, on a $1.5 million note, that's $75,000 of cash flow that's leaving my operation this year that I'm trying to cover with lower prices. And so that makes this year really tough. And I guess the scary thing is that 2024, we may see just this continue. We may not see interest rate declines until the first part. So when you're renegotiating next year's operating notes, it still may be at these elevated levels, which is something we need to keep in the back of our mind as we develop plans. And it makes me wonder if we need to be considering some small sales on this rally that we're seeing right now. And we'll kind of get into that, even if they're lower than our cost of production. So rolling into 2024 pre-harvest corn plan implementation. Basically, this is a chart in December up through last Friday, okay? And last time I checked, December corn was, I'm looking at my notes here, down 3 cents at 470. They closed last Friday at 473. But you look at that, and we're in an uptrend. We've put on, since the end of February, about 50 cents. Now, in my plan that I've kind of outlined, and I won't go through it, but it's in the back of your handout, so it's in your slides that you got. First increment, 20%, and I'm saying, hey, we ought to be shooting for 565. I want to be aggressive. That's not even on this chart, right? Prices instead have gone down. I have a date target of June 1, which is 30 days from now almost. But we're seeing a minor uptrend. Do we think that maybe we want to take advantage of that, right? Do we want to take a look and see if we can take advantage of that? And so let me get my slide going here. Yeah. Do we price at less than my cost of production. That's something to think about. My estimated cost of production was $5. Now, I think a lot of folks would say this market's probably going to move sideways, and we'll have to listen to what Dan has to say. I know he's talking about later this year we could have some opportunities, but we may go very much sideways until we know more about crop conditions and we know more about crop acreage, which won't be until June 30. But, that might mean that we could see actually prices fall back down to this 445 area before they potentially go up. So I'm kind of wondering if we should be considering, taking that 20% increment that I had and actually pricing, if I can see 480, which is 20 cents below my futures target, and going ahead and pricing half of that, if I can get 480. Right now, we're not there. But, I see resistance at that 480, 482 level already, that 485 level. And we also have a gap at 502. These things are going to be tough to get through. Now, again, if it turns dry, it could change everything. We need to listen to what Dan's got to say. But we've seen a nice rally. Do I grab 10% of this and just get something on the books? And then wait until I get up to my futures target of $5 and do the other 10% of that first ultimate increment. Same kind of thing on the beans, except maybe not as robust, right? We're not seeing as good of a rally. It's been a 50-cent rally, which is great, but we bounced up way high, got up about 12.20, and since then we've come back down. My first increment is 20%, again at 13.25 futures, which again isn't even on this chart because it was a pretty aggressive and prices instead went down from January 1. My date target is June 15, which is 45 days away. So we got plenty of time. And we're just getting this crop in here. But again, we're seeing a price rally. And so, do we do the same thing? Do we take that 20% first increment and maybe price 10% of it, just get it on the board on this rally before it disappears? And that would be saying at that maybe that 1180 area. And then, maybe even getting the next one up there at $12. Again, that's only 20% of production. But the nice thing, at least with my numbers that I've run, if I can get priced there, I'm above my cost of production. So I'm putting 20% above my cost of production. And even if that happens in the next 2 weeks, I'd almost say, let's ride this rally up and take advantage of that. What if we don't hit those and we instead close below that red trend line right down here? What happens then? Again, if I can price 1140, I might be tempted to do that and get something priced above my cost of production. Turn them to wheat, kind of hustling through it, but you've got the slides. The same kind of thing. We're seeing prices trend down from when we started this plan in October, right? Prices have been below where they were when we developed this plan. My price target was $8. Again, it's not even on this chart. My date target is April 15, which we're past. But now we've seen a great price rally. Still below my cost of production, my futures target price, target of production of $7. I'm saying let's go ahead and take advantage. So in my plan implementation, I'm locking it in. I'm doing that first 10% at whatever we close today. Yes, that's 50 cents under my cost of production, but I feel like let's get something on the books. That would be my 2 cents. The other thing I want to point out, though, is has our production estimate changed? I think for anybody in the western 2/3 of the state, you might be in that situation where, you thought, hey, I was going to have average wheat. It ain't going to do it. So we need to be kind of re-looking at some of these things and what is my cost of production. But I think we also need to be thinking about where is this long run trend. And I do want to save some time for Dan because we want to find out what that outlook is. But boy, look at this. We've seen a 95-cent rally here in the last 2 weeks. This market may take a break and ratchet back down. Do we want to go ahead and price? And that's why I'm saying, hey, let's go ahead and take advantage of this. There's some pretty serious resistance at 683. If we retrench, will we get above that? Continued dryness might do that. I don't know, but getting 10% on the board right now may not be a crazy thing to do. And then second increment, again, has a price target of $8. Day target June 1. Let's wait till we get our cost of production or even something close to that. So I'd like to see a substantial rally before we do any more, but at least get that 10% and take advantage of this 95 cent rally that we've seen. That's implementing the 2024 crop. All right, so let's take a look now real quickly. Post-harvest, what are we going to do then? Well, seasonally, right? Seasonally, prices kind of weaken as we go from June into September, right? This is a 15-year seasonal based off of NASS prices. Kind of goes sideways until December, and then we finally start seeing a pretty good rally. And so that's good. But, typically, farmers see this price deterioration here. They know that it takes a while for that price to rally. And so really, only 30% of Kansas wheat is actually held by farmers after August 30th. Historically, that'd be the 15-year average. And looking at our seasonal, that kind of makes sense. This is another way of looking at this. Does unhedged storage pay? With wheat, I'd say on average, no. And here's all my assumptions that go into this. I've got 4 lines there. Those are essentially target prices. The green would be on-farm storage, both at a low and a high interest rate, and then commercial storage at a low and a high interest rate. And then these are the actual 15-year average prices that we've seen each of these months. So 575 is the average July price for the month of July. And basically what this is showing is that on average, post-harvest storage, at least unhedged, doesn't pay. Yes, we kind of get out in this period way late into May, and yeah, if your costs are low, it might work. The other thing to keep in mind is that the variability around that is fairly high. Yes, on average it'll get there, but the variability is fairly high, and I sure wouldn't recommend storing wheat that long unhedged. When we think about post-harvest marketing, our goal should be, right, our marketing goal should be to better our position versus what harvest values were, which is essentially, for how I look at this, kind of what prices are doing in the month of July. So that's kind of our target. And again, here we are, end of April. We're way early, but we want to be thinking about these things now, right? We want to start preparing. What kind of a plan do I want to create? When I think about on-farm storage, I'm thinking about variable costs: time, shrink, utilities, repairs, insecticide, interest. That's for the on-farm. On the off-farm side, I look at commercial storage costs, which basically your variables are your handling charge, the elevator charges you, and also your interest rate. And again, we're seeing elevated interest costs this year. One thing I don't build into my projections, like that one I just showed, is variable income. We work with a lot of producers, Dan, Rich, and a lot of folks will make that statement that, what, I save a lot of money hauling my grain to the farm 5 miles, getting it unloaded and getting back in the field, as opposed to driving 20 miles and standing in line 30 minutes, 40 minutes, an hour to get it dumped, right? It saves my harvest, maybe more so in the fall harvest than it does in your wheat. But I think that same mentality is very true. I don't put that into my costs because I think it's very hard to put in there. But as producers, you do need to kind of think about, hey, what kind of an income bump am I getting just from money saved by getting this wheat out? Okay. What are my alternatives post-harvest? Well, okay, we can store it and we can hedge it, right? Storage hedge. And that means we put the crop in the bin, either commercial, which I probably wouldn't recommend for a long period, or on the farm, and then turning around and selling futures or buying a put option. Again, I'd probably lean towards the futures. Or you can store it unhedged. Possibly that's what a lot of folks do. You can sell that crop at harvest. And I think a lot of folks do that too. Just sell it off the combine, be done with it. Again, only 39% is held after August 30. We could also sell the crop and buy a call, which is essentially a minimum price contract. And your elevator can do that for you, or you can do it yourself, right? Sell that crop, work with a broker, and buy a call option. Unfortunately, calls are fairly expensive. Another thing we can consider is selling the crop and buying a call and then selling an out-of-the-money call. Kind of call that a bull spread. It cuts off your uppermost gains that you can make, but it increases your floor. And that might be something to consider also. Okay. Now, if I store it, that's going to be very dependent on what cash wheat prices are going to do. So we really need to pay attention to what Dan says. Also, what they do relative to futures, right? What is my basis appreciation? We could actually see, if you do a storage hedge, futures could actually fall and cash prices go steady. And if you put a storage hedge on, by the narrowing of the basis, that can be very profitable. So it's something to think about. Selling the crop and buying a call, these are very dependent on what futures prices are going to do. So again, we need to think about, well, what's Dan's outlook on what futures are going to do? And not so much these old crop futures, but what's the March contract going to do? What's May of next year going to do? And right now they're fairly elevated. So if we want to think about basis appreciation, we want to take a look at historical basis. And this is a chart of Cargill. It's in Salina, so it's kind of a central Kansas example. But what you see here is that, basis has been very steady at 20 cents under. And I'm going to look at, say, maybe a middle of January. So I'm thinking, okay, we're going to put it in the bin. And this is an idea. Put it in the bin, hang on to it until, the first part of January. Okay, so what's basis then? Well, the 5-year average basis for Salina is 18 cents under. In 2022, it was better than that even, right? It was about 15 cents under. 2023, it was maybe 19 cents under, but again, pretty elevated. Now you think about the fact that, again, and I say compare that to March basis today, 626 cash. That's probably pretty close. 99 futures, that's actually all as of last Friday. So we've seen a little bit of movement, today versus last Friday. So this is sort of a last Friday look. But March basis was 73 cents under, right? Cash price was 73 cents under March futures. And so, if you say, well, that implies the potential for a 55 cents appreciation in basis. Now, again, this is April 29th. This is an April 26th look. So don't put any stock in this, but keep this in the back of your mind that maybe a storage hedge could be something we want to consider, but let's do this at harvest again, right? We'll be doing this again in May. We'll be doing this again in June and July. Let's take a look at it then. Okay, so here's these marketing alternatives. Trying to wrap up here. We can sell the grain. Right now, cash is running in that area, 620. You need to talk, find out what your local basis is and what your local cash price is. But in this example for Central Kansas, last Friday, cash wheat was 626. So we can sell that, get to 626. Now that's what I'm basing everything off of. I got to do better than that. If I sold the cash and then I buy a March out of or a March call option, I'd be looking at maybe a $7 call because March futures are at $6.99. Then, well, that last Friday that was costing me 69 cents. So my minimum is down here at 556. That's way too low as far as I'm concerned. I really don't like that. And the other thing is, futures would have to get up to 770. So we'd have to see a pretty strong, a 70-cent rally for that thing to even be breaking even. So I'm not real excited about that alternative B, but maybe C, right? I go again, I buy the $7, but to offset that 69-cent cost, I sell an out of the money 750, and I could have sold that last Friday for 52 cents. That increases and makes my minimum price now 607, much closer to breaking even. And once we see a rally to 719 in March futures, everything above that is actually helping me to gain. Now, that all stops at 750. So really, I've kind of capped myself out at the potential for about a 31-cent futures rally grab that I'm adding, gaining dollars on with that one. But that one may be something to consider. The one I'm maybe more excited about is this storage hedge, right? Current deferred basis was 73 cents. If we use a 20-cent expectation, that's kind of what it is now, which is lower than what the 5-year average is. So we might consider, that we have a pretty good shot for some basis appreciation. Again, we want to pay attention to what Dan thinks. But if we put this on the farm, I have low interest, 3.5 cents. I'm looking at maybe 21 cents in storage. So that currently is suggesting a 31-cent return over selling at harvest based on this appreciation and basis. But this is all predicated on me selling CME wheat futures. If you just put it in the bin, this kind of a gain in basis appreciation is not there. So you really want to be working with your broker to do this. But again, the bottom line is, this is April 29th. we want to reassess this come late June and 1st of July, right? That's when we really want to look at that. But I think, given where we're at, this kind of puts us in a spot where we should be thinking about this is something to consider. Okay, keep in the back of your mind. So what I've got here, I'm going to end up. This is a sample post-harvest plan. Assess the potential for basis appreciation at harvest, right? And consider storing up to 50% of my unsold wheat production on farm. Okay. If I don't have on-farm storage, then that kind of changes this metric, and I'm looking probably selling the balance at harvest. I think we should also assess the potential for that March call spread. But again, you really want to assess it. And again, I want to just highlight this is a tentative post-harvest plan. We're outlining some decisions that are going to have to be made at or near harvest. So that's like 60 days away. But these are some of the things that we need to be thinking about. Talk to your marketing team about. What would it take for me to make this work? But the bottom line is you've got to have more details, right? We're going to want a basis appreciation goal for our storage hedge. If we do that, we want to have a profit goal on that call spread. I'm not even including these because it's way too early, but I wanted to throw out a few things that you should be thinking about. With that, I'm just going to stop. I'm going to say thanks so much, as always. And it's never too early to start thinking about 2025. Just throw up the futures market prices for these corn, November soybeans, and July wheat. With that, I'm going to stop my share, turn it over to you, Dan, but I just appreciate the opportunity to be here again, and can't wait to hear what you got to say, Dan.
All right. Thank you, Mark. Rich, tell me what you see when I bring that up. Do you see the screen?
Yes, I see your slides. You need to make them full screen and then go ahead and duplicate it.
We'll get that here in a second. Okay. Just get step one done. There we go. And then no doubt we'll need to find the place. So you're seeing a split screen, right?
Right.
Okay.
Yeah,
Show
go ahead.
Taskbar. All right. And to get that to yes, Rich, if you'd help me on that.
To get rid of that top thing, if that's what you're trying to do, then
we need to merge options. We need to merge the screens.
Well, that's on display settings, the second one there.
Oh, right here?
Yeah.
Yes, okay.
Oops, I can't see.
There we go. And get that last thing.
There you go. Yep.
Okay, and so then what we're looking for on that top is hide the video. Let's see here.
No,
hide floating meeting controls. That'd be it. Okay. Well, thanks. Thank you very much, Mark. Sure appreciate what you've presented. And we started out the year on those marketing plans, looking at levels we'd seen the last few years. Then we've seen pretty much any projections that have come out from the USDA, a lot of others have been pretty much assuming large crops all the way through. And I would go so far as to say that what we've had so far, at least out of the USDA, are probably, I would view them as say, 440 corn, 440 grain sorghum. Those are numbers that if we get a large crop, that's where we think we'd end up at harvest. That's how I'd view them. But we're not at harvest yet. We still have the uncertainty to deal with. And I think that the soybean number was 11.20, as I recall, and the wheat number, the wheat price, pardon me, was $6. So again, all these are they serve a purpose. They're kind of a reference point of where harvest prices would probably be if we have if we get normal production and no major shortfalls that beyond what we're anticipating with regard to usage. So I guess our job today, I think, is to take a look at what the possibilities are, or where we stand right now. Again, given that those projections, the first projections came for the USDA, were made at that Outlook conference meeting. It was on February 15th, 16th, I believe. And and to see what the likelihood is of pardon me, those outcomes coming into bear. Now, on May the 10th, we'll have the first USDA, well, we'll have the next USDA WASDE report, but that'll be the first one, the first WASDE for this year that actually includes the new 2024-25 marketing year projections. And I'd fully expect them early on to continue that same theme. Again, they'll take the acreage figures that came out of prospective plantings. They'll probably take trendline yields, probably too soon to change those, and they'll make a projection. I wouldn't be surprised that the first set of numbers that we have coming out will probably also be not too far not too far off of those same supply demand balance sheets and price projections that they'd had. But let's take a look at it. See how from our view, where we're not bound in the same way as they are to have to strictly assume normality, where we have more freedom to look at the possibility of things being non-normal, and that's where we can be of help. So we got let's take a look at the weather, and the drought monitor as it sits right now does show almost all of Kansas, except maybe a little bit up in north central being in some type of dryness. A lot of Iowa, parts of Missouri, and again, we've had some rainfall since that time. Here you have, as of today, the most recent short-term composite drought indicator, not looking quite as dry. Again, given some rainfall that's happened recently in parts of the eastern Corn Belt, but pretty rough still. South central Kansas, parts of as you head to the west, etc. You do see though that the longer term view on the drought as I guess a composite drought indicator is for areas that we're not really worried about at the moment, still having a lot of problems in terms of dry subsoils. So in these areas to the west, you can almost see the eastern border of Iowa and Missouri there, defined by the rivers. So to the west, we're probably going to get the crops planted without a lot of challenge. We have had some rain here recently in the state, so that'll be an issue, no doubt, to deal with. But I guess unless we really have ongoing continuation of a lot of rain falling, probably get the crop planted, and then we'll start looking towards the sky and in a lot of these areas and seeing what comes in terms of moisture. And so a lot on the line, a lot undetermined as of yet. From the world point of view, you still see from this NASA satellite perspective where things are dry at in the world, and you can see our dryness. This map even shows a little bit more coming up from the southwest into the U.S. Corn Belt. But again, you're over down in here, South America. If you can see my cursor moving, the same areas we've been concerned about for a while. In Brazil, again, coming into play. You see areas that have been getting in Argentina, and parts of southern Brazil having too much moisture of late. So that's been a concern. We do see some of these areas up here. We're probably most concerned right now in the world grain markets about dryness that's emerging up here in the Black Sea region, something that could derail several good years in a row of wheat crops and other crops out of that part of the world, with all their other troubles and maladies they have going on. Here that you have some signals even coming from the Russian government that they may not have as much wheat available this year to export as they've had in the past. So we'll see. China, again, a lot of variability, a lot of moisture in parts of it, dryness in some pretty critical areas, North China Plain, etc. area. You see it awfully critical in parts of India. They have some shortfalls in their domestic wheat production they're worried about. What we were worried about for Australia, for really dry conditions, not so much at this point. And I think some of our larger weather term patterns are into play. I wanted to show you this, and this isn't to, and showing you this, I'm not trying to just scare folks or beat the drum for anything, but it's objective information from a couple sources that are sure worth looking at, that probably impacts a bit how we look at the risk of this year. Now here out of the Climate Prediction Center, U.S. agency, the National Weather Service, part of that, April 11th, latest information out of them. They talk about a transition from El Nino to ENSO neutral, likely by April, June 2024, 85% chance, with the odds of La Nina developing by June, August 2024. Now there's another source from Bryce Anderson, long-term ag meteorologist out of DTN, brought up the question of how could a developing La Nina affect corn yields. This was mid-March. With La Nina, and I'll just read it. With La Nina indicated to form by mid to late summer, there's a notable potential decline in corn production from levels posted in the USDA's 2024 Outlook Forum, and ditto that on soybeans, if not even more. Again, given the importance of the August timeframe for reproductive processes for soybeans. So he comes out and talks about, rather than, in so many words here, about a 15 billion bushel corn crop projected coming out of that forum, and there's been acreage changes since that time as well. And so this was March 18th that this came out, and since that time we've dropped, basically lowered U.S. corn production, prospective plantings estimate of corn acres by about 1 million acres. So this was on the old number, about 91. Now it's about 90. And it was projecting, given similar years, 2010, 2020, thinking that, we'd have about a 7% decline in production, given these type patterns. And it take you down to something close, about 1 billion bushels lower, something closer to 14. Now with some lower acres, it'd be a bit lower than that. His summary idea is La Nina settling in during the last half of the growing season is in the analog years of 2010, 2020 was significant in its shaving of U.S. corn production. Suggests that there'd be some yield downgrades as the season progresses. And another part of this article, you can see the type of maps that they're looking at. It's a probability-based map from International Climate Research Institute. Call for warm to hot weather, drier than usual conditions in central U.S. during corn filling period, July, August, September, because of the forming La Nina event. So, my only thought on this is that when say there's a 60% chance of it happening, I know well that 50% is a coin flip. So it's a little bit more than a coin flip, but the weather patterns are such that it's something to remember. And so Mark, on both, that would affect, like, I don't know that we hold a lot of old crop grain in storage all the way out to July, August, September. You're kind of waiting for the home run to happen if that's the case, or if supplies get really tight, but you have a pretty tight window. But what this does, if this type of situation happens, then we're looking at more of a so we haven't seen in the market yet price volatility and uncertainty that would be reflected to actually show this event, these events that would come on. So just something to think about. Feed grain, I want, again, we had given you this slide set. I do want to talk about some, there's a couple, 2 or 3 key things here I want to show you, and some of these slides I'll move pretty quickly towards. Can see for July corn, now if we're not in delivery, we're right there for the May contract. So now we've switched over to July, and that closed at 450. Well, right now, as I've got another screen here, it's right now it's 449 3/4, down about 1/4 cent. So really unchanged. It came down off of the downtrend, and we've been pretty much trading in a range of about 434 to about just under, well, about 460 since early March, and now about 450, and that's on the July contract. There we go. And you do see this is on Friday's closes, and not much change now. Decent corn now 472 3/4 was 474. That we do have some carry in the market. You can see about how much it is. So Mark, this ties into your discussion, your thoughts on old crop carrying charge. Of course, it's like so many things in life, it's just speculation until you commit, but we do, at least on the future side, see some carry on storage. Any thoughts on that?
Yeah, I mean, that's exactly what, with the March so high, yeah, I definitely feel like that's something we need to continue to watch. And I guess, I'm open to your interpretation, whether we'll continue to see, the strength short run, or are we going to see, like, let's say we see a rally for wheat. Because I mean, like I say, I look at my window, you drive around Kansas, it's in bad shape. But it's just Kansas. But if, will we see March continue to go up too? But that's a pretty big, yeah, I think there's good carry. And like I say, it looks like a storage hedge could work. The question though is it, will futures continue to rise up? Or like say, will March futures go from $7? Are they going to go to 8 with these concerns? Or will we really see, it's more of a cash thing, because now we start getting more exports, more demand for grain, and so the cash price is strengthening compared to, say, March futures.
I think if we had a group of grain elevator operators sitting here and they see that 4.5 to 5 cents carry out beyond June, they say, man, that's money. But I think farmers, our general ag producer group, not dealing with near as many bushels, probably more likely to be aware of the what could be lost on a rally from that. So we're inherently a little more speculative on the at the farmer level with our scales, as opposed to elevators. That, man, this is a business decision. I hedge that baby. So let's go on. I do want to say, again, we've talked about this before. We had for monthly futures, corn futures prices, we had dropped down into the level where we used to call, like, the at least as I've identified, as kind of the $3 4.75 range, when we didn't have much going on. We don't have much going on in the market, not a drought or a geopolitical issue or a financial catastrophe or whatever, COVID-19, you name it. We dropped down into that same range. Not all the way to 4, but so we're kind of somewhere between 4 and 4.75 right now. And Dees, of course, is on the top end of that with its carry. 447 on Friday was closed, and and we're still dealing with, haven't unwound the general idea of these of a very, very bearish view in the markets. That's what led to those prices going down. About if these are in millions of bushels, this 2,000, that 2 billion bushels, over 2 billion bushels bearish. And so whatever happens, if we are going to get a rally if corn futures move higher because of these U.S. domestic or foreign supply demand issues that are still at play, then the market will have to buy out of those positions. But we're about to enter into May delivery. I'd be really curious to see where we're at in 2 weeks after we get through the delivery period for the May contract. So there's some things here in terms of the pattern of prices. Out of this, in so many words, the key issue is, I look at the again, we have basically a pretty straightforward modeling mode where we look at what futures are out into that next marketing year, again starting September 1 and going month by month, and taking current basis levels and extending them on out into the future. And so far, you kind of see what happened in the brown tan line, where we had come down to low in February, a little higher in March. These are futures going on out there, probably not rewarding storage, Mark. Following the general trend, that's that purple line. But for the new crop bids, so we come out of the end of projected end of this year, the August number, come into the beginning of that next marketing year, and it's pretty flat. You got a little bit of carry. That's that line in the red. So what's the market telling us for next year? Well, it's showing a harvest number with a little bit of carry because it doesn't know what's out there. So I it's not that I don't put a lot of stock on this, but to recognize what it is, it's kind of a myopic view of the future with no idea what's going to hit us. And we have an idea of where it could come from, but we don't know exactly how it's all going to play out. This big issue right now of corn acres, that number down about 1 million in that March 28th report. And that, so what does 1 million, what do 1 million acres less corn planted and about that many less harvested, what's that do? Well, that times whatever yield gives you about how many hundreds of millions, 100 million, that's right, 100 million bushels that you're dealing with. So you can kind of see where that comes in. And Mark, as you had stated, we'll have the actual acreage report at the end of June, and that'll tell us a lot for corn and soybeans, sorghum, and the rest. Corn yields. This is my issue of. I know my good friend Doug Bounds is on here and with NASS, and so I want to sure respect what's going on there. The highest yield we've ever had in the U.S., 177.3. You can see the previous highs are about 176. So we've came out in the Ag Outlook Conference, projected a long-term trend line yield, got us to 181. If you include the lower yields that are back to the left off that screen, you get to 181. Last year, coming out of that's 181.5. So, but the record high that we've ever had is the 177.3. So it's a open thought as to where we're going, and can we get with our genetics, can we get to 181? Absolutely. It's not unattainable, but you can't miss many beats, and you're including a lot of fringe areas in the Corn Belt that don't grow grain, have as much corn production capacity right now with their genetics as again the 3I states. So even with that, so you're not, so you take the 181 bushels an acre, take it times the type of acreage we're talking about now, it's been pared down some, you're at about 14.9 billion bushels. And that's with the 181. If you come in with something less, then we're probably, if we're 175, 176, we don't have wonderful normal conditions, we're looking at probably closer to 14.5 to 14.7 as a number to look at for production. And that would have a difference on that corn supply demand balance sheet and prices. Some things are going to skip by pretty quick here because of time. Corn stocks, the latest figures we've got right now as it stands, 181 bushels is this marking year ending up just under 14.9% stocks used, 2.1 billion bushels. Next one, about 15.8, just under 16, about 2.3. And again, if so the projection for harvest of 2024, if nothing else, if we don't have a hiccup any place, 440, and probably 4 to 440, something like that, with those. So here'd be the point where I would where we should think about where this thing is going. Here you got the 2023-24 marketing years. It's the 177.3. The production's not in question right now. At least we're not focusing on it. It may be adjusted sometime later, but based on some stocks numbers. But this is where we're at right now, and so this second scenario is where at least I would bring in thoughts about challenging situations down South America. Again, we still have disagreement between USDA, World Ag Board, and CONAB in country as to what the size of these crops are, and the market is trading the USDA numbers, and the USDA is waiting for confirmation, etc. So if something happens to make that would signal short corn production down in South America, then and it would lead to higher U.S. ethanol prices, higher U.S. Particularly exports to fill the gap, then you're looking, instead of the USDA's 470 number, which that's what the futures are trading, basically 471 by the model we put together. If you have a late shortfall, again, you take about 13 and a half, well, about 1.5% off the stocks to use. You finish the year pretty strong. That's 525 as a season average price. So Mark, if this happens, then storage, old crop storage, for people that were unhedged, they would be happy. But this is again, how much do we put people in a speculative position in their cash storage to wait for something like that to happen? So that's just the challenge of it. But the new crop side for corn, this first category here, I give it about a 1/3 chance of happening because we haven't been within 3.7 bushels of this yet. But anyway, that's the number that's out there. 2.3 billion bushels ending stocks, 440 projected price. The market right now is bidding. It's basically hovering around $5. So I think the market itself is taking into account the lower yield, lower acres, and probably they're about plugging in the most recent historic high yield, ending up with ending stocks. I see I've got a thing I need to change there. Ending stocks are around 2 billion bushels, and that's at the record high. If we plug in a 177, 176, 175, any type of a dry situation, we're back down to 1.5 to 2 billion bushels carry out, and pretty strong prices. So Mark, when you and I were talking before we came on air about identifying price goals on down the line, I in my own thinking, there's a lot of uncertainty here, especially with the weather forecast sounding some warnings that very likely could see some volatility in the markets heading forward. So what I'd like to do is I'm going to move pretty quick. As usual, I basically have been talking more than I should have, but let's kind of move here. I want to take a look at sorghum. We have had grain sorghum exports have been running decently. It's not the very highest we've ever had, but it's been pretty good. And bless its heart, that's been and we've been seeing regularly higher, stronger basis for sorghum than we have for corn. In the export-oriented areas, again, pick them out: Salina, Topeka, Hutchinson, pretty strong grain sorghum bids, and you can see the strength of exports. We can use sorghum for a lot of things, but exports have been driving the bus for a fair while now, and a lot of that's dependent on China. So then you come in here and you just look at the USDA's projection. I'd say it's about 35% chance of being right, and then plugged in either lower yields, higher yields, and really you're shaving exports one way or the other. It's kind of what you're doing. But if you do get lower yields and and the exports demand out of China remains strong, 540. The futures with the current basis levels, they're bidding about 536. So not far off of where all that's working. Soybeans, take a quick look here at beans. You can see the long-term downtrend that we had all the way from basically back in the highs around mid-November down here to early March, have come up and you get set a low below 11, well, at about 1130 thereabouts, traded within range of 1130 to about 1240, 1245 thereabouts, closed here on Friday 1177 and a quarter. And that price, just interesting to look at this 1179 3/4 for the monthly number as they close that out. And 1185 is about the top of that long-term price range. So for both corn and soybeans, we've come down, we've peaked into the scenarios that are lower. And we've been hesitant to go much lower than that. But so this probably, I don't know. I'm thinking that these type of prices, if we don't get a big shock or surprise out of South America on their numbers, we probably hang around here, and unless we get a large crop this year, and then we would move lower towards somewhere lower towards this $10 to $9.60 area. Futures, you can see again, managed money. We're dealing with a lot of pessimism in these markets, and this downtrend that was built on all this selling. And again, you can see about 900 million bushels of these are short positions, sell positions. And I want to, there's the soybean acreage figure. So many thought that number would be higher than it is. But came in at about 85.5 million acres planted as that's what came out of the prospective plantings report. So, we're in the mode we've been in before. If weather's good on corn planting, do we stop on the margin? And where do we go? And if for acres that we haven't bought seed for, they have some flexibility for, probably the relative profitability of corn versus soybeans probably affect how this all works out at the end. I want to come down here and take, so the USDA's projection here for 23-24, this is the latest number that came out of that April 11th report, and 340 million bushels carry out, 7.6% stocks to use, 1265 price, futures about right there. And I guess and let's say for both corn and soybeans, 3/4, that's probably right. But you do have this looming question, this argument going on between in-country South America sources and particularly Brazil, and what the USDA says, that there's a potential that if CONAB knows better what's going on in its country than the USDA does, then we'll see some real market volatility. And where do you look for to get a signal on that? I think you look at basis. If we start seeing local elevators have buyers from other countries saying, hey, I'm unsure about those supplies out of South America, or they're starting to get expensive and getting tight after their harvest rush, or glut, I should say, and we start getting those local elevator basis levels to fill trains to start being higher, well, then we'll know something's afoot. And then for next year, put about a 40% likelihood on the USDA's projection. It's not to besmirch them, but just to say, hey, there's a lot, probably gonna look different out of this by the time it's all done. If you just take that yield down 2 bushels an acre, only 2 bushels an acre, and keep the usage the same, you go from 357 to below 200 stocks to use, instead of 8%, 4%, and you add quite a bit of a price on top of that. So Mark, I guess if you disagree on that, that's fine. It's sure open to disagreement, but I I just think for both corn and for soybeans that we're not so overwhelmed with supplies that and especially with these weather forecasts, that we shouldn't be thoughtful of where things could go in terms of the markets out this summer yet.
You bet. That's good stuff. Just a quick point then, yeah, because in our original plans that are in the back of my handout, we had all these price targets that were very, very aggressive. But looking at this, then if we just have the patience to wait for some of those price dates, that may be the better thing. Just follow those dates and make some price because sounds like we got some good odds for, especially on the bean side, a rally in prices. Fair enough to say?
It's out there. I wish that options didn't cost so much, because this would be perfect for options if they didn't cost so much to put us in position to allow the top side to come to us and not be tied in with if we could buy in puts at a reasonable price, that would be so helpful. But by the time you go in and so why aren't puts at a more reasonable price? Because people think about this stuff and they're seeing the same things we are, thinking, if there's downside risk to be had, then by golly, we'll charge something for these put options that protect the downside. And so the market is expressing its opinion. Let's finish up with wheat. Long-term downtrend for wheat. A lot of it born on hard red winter wheat exports out of the U.S. not doing well. Hard competition from the Black Sea region for again comparable products. Downtrend did have kind of low, sort of stopped that long-term downtrend at somewhere around 540, 545, something like that. Since then came out of that and a little over 550, haven't gotten below that. And since then it had gotten up to about 6, and then suddenly we popped up about 50 cents higher, Mark, and 654 close on Friday. And a little bit of carry in that market. And so this to me is kind of an example of again, I don't know how many people still have their old crop wheat. They may have moved that a while back, but so here we've got from June moving on, again, March contracts off the board, May just about there. So you got about 4 to 6 cents, but we just saw a movement of about 50. And so that's what's worked so much against farmer storage hedges. We would be really well served probably to do more storage hedging, but you miss out on half of that of what could happen, and in a lot of farmers' view, that's quite a trade-off to have. And for wheat, when we ran that thing down off of what happened for hard red exports, we basically got down, we dug deeper into that long-term lower price range, basically almost got to 550, but have come back up now to 650. And even though we went lower, we're at about the same place corn and soybeans are, just a different path of getting there. And I would say also that turn something off. Okay. Here it is. Anyways, so you can see a lot of bearishness in managed money traders. Still a net negative, and according to this, again, it trails about a week. We're kind of holding steady with our bearishness. But again, we're coming into the May contract delivery time frame. Where are we going to set in about 2 weeks? That would be of more interest to me. And you can see here again this is that low we've seen in January, February, March. We've started to come out of that now in May, coming into the next crop marketing year. Still not, even though we've had a run up in the front month, we're still sort of docilely showing just a little bit of run up. So if something's going to happen in the wheat market, it's not that's very volatile. It's not being reflected yet. And I would say get down to the ending things. I wanted to show you this has been our worst issue in hard red. U.S. wheat exports generally doing okay. Soft red doing very well. Hard red spring having its moments, doing decent. The hard red winter, again, you can see that path just running lower than anything we've seen since 2015-16, and that's a world issue. It's a world Black Sea issue. They've had both a war, geopolitical issues, and good weather all led them to this place where, man, they've just been competing tough against us, and we've had the higher price dollar, Mark, as you mentioned before. That hurts us, especially on wheat, because there's so many other places, relatively speaking, for so many more places to buy wheat in the world from than corn, soybeans, or even sorghum. That really hits us on the wheat side. So I want to get to that. So this is where the wheat stocks to use some prices are, and there's that $6 projection out of the coming out of the USDA Ag Forum. Again, we'll get an updated number here on May the 10th, where they think prices are at. But $6 as a conservative figure. Latest numbers about 43 some. Excuse me, for this market year, about 38% stocks to use. If you use the USDA's figures, about 43-44% in projection of where things end up at. And so here would be my own thoughts on this. It's probably about a 50% chance they're right, which is, you could say, well, O'Brien, that's not very bold of you to say it's 50% chance. But again, we haven't seen the exports turn around yet. You have some other things that could happen. Right now, we're staring right down the barrel of something a lot less than just sterling hard red winter wheat yields. We've had some moisture, other places not so much. So that's kind of scenario 2. Scenario 3, a move higher. That's about 100 million more exports, and that I would call that the Black Sea region, Russia in particular, shortfall scenario. What happens if they both come in? So instead of that $6, both scenario 2, scenario 3, either way, you're at about 36% stocks to use, 36.3, 0.4 thereabouts, about 760. The futures right now are bidding about 660, and so there's a 5% chance, 1 in 20, that we're tight on our production. They're tight on their production over in Russia. Can't come into the world supply so much, and U.S. exports demand pull suddenly there, and I almost so you've got a figure out there. If you just crank the numbers, you're closer to 600 million. Carry out stocks to use about 30%, and it's $9 wheat, 1 in 20. But so I guess my point is, I wouldn't go to sleep on what could happen in the wheat market just because we've been slumbering for about the last 2 years. That'd be my thought. Okay, so with that, and I've finished with this again. Wheat stocks to use. The rest of the world tight as all get out on take China out of the equation because of challenges in interpreting what they have for stocks. Again, we just keep going lower. 19.5% stocks to use. Haven't been that low since way back in 2007. And so there's just a lot of potential volatility in the wheat if we wake up someday and they don't have a wheat crop in Russia to keep feeding this market with cheap stuff, and the world looks around and doesn't have a lot else to work with. So, okay, with that, all right. Well, thank you all for hanging around. We went a little bit beyond one. My fault on that. Are there any questions that we need to ask? Or
Dan, there is one in the chat.
Okay, let's get back to that. Can I put my finger on the managed money traders' reason for the negativity? Well, this is my own thought. We have all that much more computerized trading going on, and they're looking for hard numbers, and the numbers that they're looking at are the USDA numbers. Again, they in terms of they're looking for quantified data. It's probably out of the USDA, and this is not a criticism. Doug's listened to this. Not a criticism of USDA. They're doing their part. They're stating what happens in these markets if we don't have shortfalls, if with normal weather we go forward. That's what they're showing. So when when more increasingly computer oriented markets, trading markets look to that, then anybody that has a disagreement sticks their head above the foxhole, man, they're a target. Nobody can lead out ahead of that with such computer near instantaneous reactions. So I think that we're in a situation where we're pretty hesitant to show any positivity in the market. And there's an old saying in the economics that it's easy to predict the trend, and the trend's been down and negative. It's difficult to figure out the inflection point when the trend is shifting around. And so it's been a lot easier to just stay with the trend, etc. Trust that Russia's going to keep coming forth with lots of wheat, and no place else in the world's going to have a problem than it has been to say that, gosh, I guess this is changing. My contention would be that the traders look at the trading data set, and what'll change that volatility will be things in the cash market. Just the reality of that. Hey, our presumptions on these large supplies, they're in question. I don't know that markets right now are valuing risk that much. I think they're going on their trusted projections, which are pretty negative on supply demand out of different sources, USDA being one of them, and they're just not that willing to run higher until they're absolutely forced to. But I am open to debate on that. That's just how I view it. So
there's another one there, Dan. Also, folks, I've opened it up. If you want to just give a question orally, you can unmute and talk to Dan since we have a small group.
Yeah, given that Dees corn tends to make a seasonal high in May, June, what do you folks consider the odds of that happening 2024? Seems to be a considerable amount of weather uncertainty brewing this year. My thought would be that if anything, if dry conditions are forecast more for later in the summer, I wouldn't be. I think there's a little higher odds than normal that we'll get the crop planted. Even with the rain we've had, we'll get the crop planted, and we'll be looking around and doing what we so often do in July and August, at looking towards the heavens in the Eastern Corn Belt to see what comes. But this weather switch that again, good trusted climatologists are talking about, it's a little bit more backloaded. So my own thought would be that unless we're surprised, it doesn't seem that we're going to be worried about getting the crop in. It's July reproduction for corn, August reproduction for what's happening out there what am I trying to say? For soybeans, that'll be more a concern. So here you ask me a question, and I give you about a 5-minute answer, dance around it. Basically, I think the weather risk, from what we can tell, is probably going to be more backloaded than that, and then the highs may be a little bit lower. At least the risk is more backloaded, it would seem, Ward.
Yeah. If I could weigh in there a little bit too, typically when we see a year like this, where say from January and for the first 3-4 months, prices trend down, I think Ward's exactly right. We typically do see those rallies, and a lot of times we do see that April, May, June, July. Some point we will. The question, or the hard, to me, the booger of it is okay. So yeah, we see the rally. how much, how high will we go? And unless this weather falls all the way apart, I kind of go back to we could be seeing part of it now, but we do have that gap at $5. I mean, it may be another 25 cents. That may be as good as it gets. That could be the weather rally, and so I think when we start, because I think as you try to implement a plan and decide, because we want to wait for a rally. When do I say, okay, I think it's kind of hit it, short of a black swan, Armageddon wars and, nuclear fallout, type of thing that just blows everything up. Typically it's hard for the market to rally a whole lot past where we were in January when we see it just pound down early.
Well,
And so, that puts us back to that. Well, gosh dang, we may be doing as good as we can, get up to $5, $5.25. Because I think the key thing in that, when we see the rally, and maybe we are, how high? When do I pull the trigger? At least on a few of my increments.
in that situation, the markets are groping. There's a potential for worse conditions, for better conditions, all out there. So it really is it's a groping and a stumbling operation to figure out where things should go, and people are looking at different scenarios. And so, as you say, Ward, when things do move lower after June, what's happened? Well, crops in, we had some dry weather. Gosh, looks like rain's there, and we're not really worried yet. So we go sideways to lower. And if we really ran up on fears and suddenly a lot of rain comes in, it's a lot of volatility up and down. But